for Bitcoin, most of the indicators that I track point to being fairly mid-cycle in terms of the bull run. Um, and so I still think the next 18 months look favorable for the asset. Again, it tracks global liquidity pretty well. The on-chain indicators can, show us, for example, how much long-term holders are selling into the current strength, because even though obviously Bitcoin supply is constrained, if the price goes up, 3x or 5x in a fairly short period of time, you generally see some of those older coins start to come to market and start meeting that new demand. And we've seen some of that, but so far we've seen less of that in this cycle than in prior cycles. And I still think that there has to be a higher price to unlock some of these older coins to meet that demand. And so I would be surprised not to see six-figure Bitcoin over the next 18 months.
Renowned macro analyst and investment strategist Lyn Alden has expressed an optimistic outlook for Bitcoin, the world's leading cryptocurrency by market cap. As global liquidity conditions shift rapidly, Alden anticipates that safe haven assets like gold and Bitcoin will outperform and experience further price increases before the current cycle concludes. She predicts that Bitcoin will reach at least $100,000 within the next 18 months. Alden shared her bullish Bitcoin prediction during a recent interview with Blockworks Macro, alongside Luke Gromen, a popular macro strategist and Bitcoin advocate. She attributes her optimism about Bitcoin's price potential to its core fundamentals. The periodic Bitcoin halving events reduce its supply, creating scarcity and driving up mining costs. This leads miners to hold onto their block rewards, further limiting the available supply and exerting upward pressure on prices. Additionally, the approval and successful launch of nearly a dozen spot Bitcoin exchange-traded funds in the United States have provided a new avenue for institutional investors to enter the Bitcoin market, contributing to the asset's rising prices. In her interview with Blockworks, Alden also discussed the current macroeconomic situation in the United States, comparing it to the inflationary decades of the 1970s and 1940s. She believes that we are entering another inflationary decade characterized by persistent and challenging inflationary pressures.
Ever feel like you're wasting your money on things that don't really matter? Stop. You don't have time. Don't miss out on this 2025 bull run. Educate yourself now. Don't spend $12.50 on junk. Educate yourself on how to be successful in crypto using our Crypto Cheat Guide. Unlock the secrets of crypto and make smarter investments today. Visit the website now on the link in the description for your exclusive copy. Start your journey to crypto success today.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I've pointed out in some of my newsletters the concerns people had in the 80s and early 90s around the debt levels. So, for example, the famous debt clock went up in 1988 or 89, and then Ross Perot ran the most successful independent presidential campaign in the early 90s, largely based on debt and deficit. That was kind of a main issue of his, and so that was like peak zeitgeist of that this matters. And if you look at the chart of interest expense as a percentage of GDP, that was peak interest expense, because even though federal debt was still fairly low, they had ultra high interest rates, and therefore they had they looked like they had a spiral starting. Now they had the fall of the Soviet Union, they had the opening up of China to the world, and then they had this kind of 30-year stretch of major globalization, interest rates falling from double digits all the way down to basically zero. And so if I would describe the fiscal problem in one kind of frame, it would be, we've had 40 years of rising debt to GDP, but it's been offset by 40 years of falling interest rates until we hit zero. And so if we just go, sideways now, let alone up, but if we just go sideways now, then we no longer have that offset of interest rates compared to the debt. And a lot of this is locked in, and now we're well over, 100% debt to GDP. And so I think it's almost ironic. I think basically because so many people freaked out in the 80s and 90s around the debt and deficit, that a lot of analysts then say, okay, that's kind of like they were way too premature. The lessons we learned is that debts and deficits don't matter. That's how a lot of people took that. The pendulum has swung so far that now people are in the mindset that debts and deficits don't really matter, and is starting to matter. And so, for example, we've had the longest period of the Conference Board leading indicator being like in recession territory, and yet not having an official declared recession. We've had, PMIs went down. Normally bond yields go down when that happens. Instead, bond yields went up. And as Luke pointed out, that chart, gold and real rates diverging. The fact that the Federal Reserve had to come in and stop reducing their balance sheet in 2019 while there's still an economic expansion. These are all kind of things that start happening, and it's not like one Boolean outcome. Like now we go from not in fiscal dominance to permanently in fiscal dominance. But over the past, call it 5 years, there's been a number of pretty clear indicators that various signs of fiscal dominance and EM-like characteristics in the U.S. are building. And so I don't think it's a matter of like, okay, here, like 2028 is like the date that we're going to enter fiscal dominance. My view is basically ever since 2019 or so, we've roughly been flirting with it. That's fiscal is now a bigger factor than it normally is, and we don't have that 40-year offset in lower interest rates to offset that. And if somehow, let's say if AI comes and just completely gives us this massive disinflationary force and just kind of holds down, they're able to have low interest rates despite fairly high money supply growth. Well, then I still want to be in kind of the same assets that I'm in anyway, which I'd rather be in gold and Bitcoin than treasury bonds, for example, in that environment. Fiscal dominance would be less inflationary if it imploded the private sector. So, for example, by raising rates so quickly, they blew out interest expense, but they also killed some of the banks. But when those banks started to fail, instead of letting deposits that are uninsured go bust, they bail out the deposits, and so they kind of soften what happens on the private sector while putting the gas on the public side, and that's where you get fiscal dominance being more inflationary. So it could include things like SLR rules changes, kind of financial jargon that helps banks hold more treasuries, which is also basically what they did in the 1940s. It wasn't just the Fed monetizing all the treasuries; it was other pools of capital, including banks. And banks, because they have fractional reserve, policies, that they can hold quite a bit of treasuries depending on regulations around them. Especially if those treasuries are shorter term.
Inflation has been a persistent concern over the past 3 years, exacerbated by the pandemic as central banks initiated substantial and largely unprecedented monetary easing measures. Despite warnings from financial experts about the potential dire consequences, concerns heightened further when central banks began raising interest rates in 2022. While central banks, including the U.S. Federal Reserve, believe that the battle against inflation is nearing its end, Lyn Alden warns that we may be at the beginning of an inflationary decade. According to the renowned macro analyst, central banks lack the necessary tools to effectively address the inflationary pressures we are facing. Alden believes that we are entering a prolonged period of inflation, challenging the conventional belief that inflationary pressures are temporary and easily manageable. Here are additional insights from Alden's interview, where she elaborates on the complexities of the current macroeconomic landscape and the potential challenges ahead.
I think we're going to have higher highs and higher lows of inflation than we had in the prior decade. That's how I would describe a secular inflation. And kind of a major thing I've been pointing out is questions I got over the past couple years were, are they going to get inflation back down to 2%? And my answer has generally been, I don't know, but I don't think that's the right question. I think the right question is, what's going to happen with inflation the next time we have an upcycle in PMIs, for example, like Manufacturing Purchasing Managers Index, because I think that's the real test. You can get inflation down temporarily if you're willing to have a recession, if you're willing to disinflate enough, and that's kind of the pseudo cycle we've been on. It's obviously been offset by fiscal, as we've been talking about. So they've not gotten it down to 2%, but they have muted it significantly. We're starting to see early signs of PMI reacceleration. Kind of rotation in what sectors are doing well. And so I think the big test is, if we get an upcycle in PMI, what does inflation do? My expectation is that inflation goes up or stays sticky when we get that next PMI rise. And so it's not a matter of, could they touch 2% sometime this decade? Sure. But the question is, can you sustain there and having like another cycle of growth while still sustaining there? And I think that's the much harder thing. And so, because I think this is going to be a more energy intensive cycle, I think we're going to be more linked to what happens with energy than we have been in say the prior 10 years or so. And so I think my expectations, higher highs and higher lows compared to what we had in say the 2010s decade. The funny thing is that because we're kind of largely in fiscal dominance now, I think that the emphasis on the Fed is in many cases like backward looking. that the Fed has been a bigger source for markets for a long time. But as we kind of enter this fiscal dominant environment, I'm increasingly less interested in what the Fed does around the basis point margin. And more interested in what's happening with the treasury market, more interested in what's happening with the size of fiscal deficits, and those kind of more structural things. So to the extent that the Fed, cuts rates a little bit, or if they even add some interest rate hikes to it, it's not really the answer in my view. I think basically that the large structural fiscal deficits are a bigger factor. And ironically, if they try to get down inflation by increasing interest rates, they're going to blow out the fiscal deficit even more. And so that's the lever that's different from the 70s, but closer to the 40s. And so for me, it's looking at what are tax receipts going to be like. So for example, now because 2023 assets were pretty good, asset prices, we should expect decent tax receipts here, which ironically could narrow the deficit a little bit, which could give us kind of a somewhat weaker performance in 2024 for at least some of these, like say mega cap assets. I think those factors matter more. I think also we've seen, for example, some of the treasury decisions to shorten the average duration of their treasuries have had bigger effects on the market than what the Fed does in a given meeting. So some of these quarterly treasury releases have been bigger factors than the Fed. Obviously, during kind of acute liquidity things, like for example, the early 2023 banking issue, that was both a Treasury and Fed issue together. But in general, I think that overall liquidity, overall fiscal is actually a bigger force than the Fed. So I don't really have a firm view. Let's say a -3 cuts or plus a couple hikes. That range is largely irrelevant for my investment decisions. Obviously, if we were to get major moves outside of that range, I would start to care again. But as long as expectations or my expectations are fairly somewhere in the middle, I think that's not the biggest lever to be focused on compared to what's happening in fiscal, compared to what's happening in, say, supply and demand of oil. Those I think are the bigger forces.
According to Lyn Alden, there are two primary factors contributing to higher than normal broad money supply growth, which typically leads to increased consumer prices. The first factor is rapid bank lending, which can be influenced by a large segment of the population requiring significant credit simultaneously. An example of this is the inflationary environment of the 1970s, driven by baby boomers entering their home buying years, resulting in a surge in bank lending. The second factor is large monetized fiscal deficits, often associated with significant conflicts or crises. Examples include the First World War in the 1910s, the Second World War in the 1940s, and the COVID-19 pandemic in the early 2020s. These substantial fiscal deficits and new money creation are not directly tied to bank credit creation and therefore cannot be mitigated by controlling bank lending, as the Federal Reserve is currently attempting to do by raising interest rates. Alden believes that the Federal Reserve is addressing the current inflation, reminiscent of the 1940s-style inflation, with tools more suitable for combating the inflationary pressures seen in the 1970s. As a result, Alden contends that there won't be a permanent solution to the issue until the underlying problem of unchecked government spending is addressed. Please share your thoughts on Lyn Alden's interview in the comments section below. For more daily dose crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.